Hey everyone, welcome back to Corporate Decoder, the place where we uncover the secrets hidden within financial filings. This week we're diving into CPI AEROSTRUCTURES Inc., and boy do they have a new financial arrangement to discuss. Before we jump in, if you love getting the straight scoop on corporate moves, hit that subscribe button and join our Discord community linked in the description for even more exclusive content. CPI AEROSTRUCTURES Inc. has just filed a Form 8K reporting a significant event and new loan agreement. This is essentially their way of telling the world they've secured new financing, and it is a pretty substantial one. They've brought on Western Alliance Bank as a lender, and this setup comes with a couple of key components. First up, they have a revolving line of credit up to $10 million. Think of this like a credit card for businesses. They can borrow money up to that limit, repay it, and then borrow it again as needed. This offers a lot of flexibility for managing day-to-day operations or unexpected expenses. Then there is the term loan, which is also for $10 million. This is a more traditional loan that they received all at once and will pay back over time in regular installments. So in total, they've secured up to $20 million in new funding. Now here is an interesting detail. To back up this new loan, their wholly owned subsidiaries Welding Metallurgy Inc. and Compact Development Corporation have put their names on the dotted line. This means if CPI AEROSTRUCTURES Inc. can't make its payments, these subsidiaries are on the hook. It is a common practice to spread the financial risk, but it is worth noting that the subsidiaries are fully backing the parent company's debt. Let's talk interest rates. Borrowings on these new credit facilities will float based on something called the 1-month term SOFR plus an additional percentage. The loan agreement calls an applicable margin. SOFR is a benchmark interest rate, so their interest payments will go up and down depending on market conditions. If things go really wrong and they default, the interest rate can jump up by a hefty 5%. These new credit facilities have a lifespan of 5 years, maturing on December 12, 2030. The term loan starts getting paid back pretty soon on April 5th, 2026, with the final chunk due at maturity. The revolving line, on the other hand, can be used and repaid pretty flexibly until that maturity date, as long as they meet all the loan agreement's conditions. CPI AEROSTRUCTURES Inc. will also be paying some fees. There is a fee for not using all of that revolving line of credit, and unused commitment fee of 0.40% per year on the money they don't borrow. They'll also pay fees for things like letters of credit and cash management services. Plus, they paid a closing fee of $100,000, less a small amount they already paid. What is backing up all this debt? The company's obligations and the guarantees from their subsidiaries are secured by a first priority lien on pretty much all of their personal property assets. This is standard practice for securing loans. It means if the company defaults, the bank has a primary claim on those assets to recoup their losses. Now let's get to the nitty-gritty, the rules and restrictions. The loan agreement comes with a pile of covenants. There are affirmative covenants say do this, and negative covenants don't do that. They'll have limits on taking on more debt, making certain investments, selling off assets, or paying dividends, for example. More importantly, there are financial covenants. They need to maintain a minimum consolidated fixed charge coverage ratio of 1.25 to 1.00. This basically means their earnings need to be at least 1.25 times what it costs them to cover their fixed expenses like debt payments and rent. If their earnings drop too low, they're in violation. There is also a maximum funded leverage ratio. This measures how much debt they have compared to their earnings. It starts at 3.75 to 1.00 and needs to decrease to 3.50 to 1.00 over time. These ratios are crucial. They're the financial health checks the bank will be watching closely. Of course, there are also standard events of default. This includes things like missing payments, breaking any other rules in the agreement, or even certain bankruptcy or insolvency situations. If any of these happen, the bank can demand immediate repayment of all outstanding debt and take action against the collateral. So what is this new money for? A good chunk of it, about $6.2 million from the revolving line, plus the entire $10 million term loan was used on the day. They signed the deal to pay off their old credit facility with Bank United NA. This is pretty common when refinancing debt. It cleans the slate and allows them to start fresh with new terms. The rest of the money from the revolving line they plan to use for working capital and general corporate purposes, basically to keep the lights on and fund their operations. Speaking of that old credit facility with Bank United NA, this filing also marks its official end. As we just mentioned, CPI AEROSTRUCTURES Inc. paid it all off on December 12th. The agreement is now terminated and all the liens and security interests tied to it have been released. The good news here is they didn't have to pay any early termination or prepayment penalties. So this part of the financial maneuver was relatively smooth. This new loan facility creates direct financial obligations for CPI AEROSTRUCTURES Inc., which means these are debts that are officially on their balance sheet. They now have that $10 million term loan and the drawn portion of that $10 million revolving line impacting their financial standing. Now to the nitty-gritty details, the exhibits, they've filed the loan and security agreement itself as Exhibit 10.1 and the form of the guarantees from their subsidiaries as Exhibit 10.2. These are the full legal documents that lay out all the terms and conditions we've discussed. And finally, Exhibit 104 is the interactive data file for the cover page, which is embedded in the filing. This is for electronic reporting purposes. So what is the big picture here? CPI AEROSTRUCTURES Inc. is essentially refinancing its debt and securing additional capital to manage its operations. They've managed to avoid penalties on their old debt and transition to a new lender. The new loan comes with the usual covenants and requirements that banks impose to protect their investment. They'll need to closely monitor their fixed charge coverage and leverage ratios to stay in compliance. The success of this move will depend on their ability to generate sufficient earnings to service this new debt and maintain those crucial financial metrics. For investors, this means understanding that the company is actively managing its capital structure and that the new debt will have an impact on its financial health moving forward. It signals a phase of operational management and financial restructuring. Alright, that is our breakdown of CPI AEROSTRUCTURES Inc.'s latest filing. What is your take on these new financing arrangements? Are they a sign of strength or a sign of underlying challenges? Drop your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for more discussions and direct access to our team. Thanks for watching, and we'll see you in the next episode.